Welcome back to the Daily AI Value Briefing for Monday, July 7th, 2026. Every day, our AI screens the entire U.S. market for high-quality companies trading at unusually cheap valuations. And we accumulate those picks through daily dollar cost averaging, adding new names as they appear. U.S. markets are digesting a strong first half of the year, with investors rotating between mega-cap tech leadership and beaten-down growth names while watching the Fed's next move on rates. That rotation is exactly where our screener hunts for bargains. Today, the AI surfaced 5 picks: Adobe, Autodesk, Workday, Insulet, and Newmont.
Now for the portfolio update. All 7 of our current positions, Adobe, Autodesk, Workday, Insulet, Viva, PayPal, and Netflix, were initiated today at the market open, so every position stands at exactly 0% return with 0 alpha versus the S&P 500. From tomorrow, we will track how each pick performs against the index day by day. Consider today the starting line for this cohort.
Adobe is the creative software giant behind Photoshop, Premiere, and the Acrobat document ecosystem. The stock sits about 43% below its high. Its valuation is cheaper than roughly 98% of its own history, and it offers a rich 10.6% free cash flow yield. Our reverse DCF says the market is actually pricing in negative growth of nearly 3% a year, which looks far too pessimistic for a business earning a 70% return on invested capital, with 89% gross margins and EPS up 57%.
Autodesk makes the design and engineering software behind much of the world's buildings and manufactured products, led by AutoCAD and its construction cloud. Shares are down about 36% from their peak. The valuation ranks in the cheapest 2% of the stock's own history, and earnings per share more than doubled over the past year. The market is only pricing in about 3% long-term growth, modest for a subscription business with 92% gross margins, a 51% return on invested capital, and 13% revenue growth. The main risk is its exposure to construction and manufacturing cycles, so a slowdown in building activity would pressure new subscriptions.
Workday provides cloud software that large enterprises use to run human resources and finance. The stock has fallen about 44% from its high, sits in the cheapest 10% of its historical valuation range, and now carries a 9% free cash flow yield, while the market prices in slightly negative growth for a company still compounding revenue at 15%. Earnings per share nearly quadrupled as the business swung firmly into profitability. The caveat is that return on invested capital is still a modest 11%, so Workday must keep converting its growth into stronger returns to justify the thesis.
Insulet makes the Omnipod, a tubeless wearable insulin pump that is winning share among people with diabetes. The stock has been cut in half, down about 55% from its peak, pushing its valuation into the cheapest 2% of its own history, despite revenue compounding at nearly 28% a year, and EPS up 89%. Unlike our other picks, the market still demands about 18% implied growth here, so this is a case of paying a fair price for exceptional growth rather than deep value. The risk is real. Fears that GLP-1 weight loss drugs will shrink the diabetes device market, plus a thin 2% free cash flow yield, leave little cushion if growth stumbles.
Newmont is the world's largest gold miner, with operations spanning the Americas, Africa, and Australia. It is the diversifier in today's list, only 25% off its high and priced near the middle of its historical valuation range, but backed by a 9% free cash flow yield, 24% revenue growth, and a 36% return on invested capital thanks to strong gold prices. The market is pricing in slightly negative growth, so you are essentially getting the gold price upside for free. The obvious risk is that Newmont's fortunes swing with the gold price, and a sharp pullback in bullion would hit both earnings and the stock.
That wraps up today's briefing. 5 quality names the AI flagged as mispriced, now added to the daily accumulation plan. Come back tomorrow to see how the portfolio tracks against the S&P 500. and consider subscribing so you never miss a pick. This video is auto-generated for personal record keeping and is not financial advice. All investment decisions are your own responsibility.